Hello and welcome to week 1, looking at forms of business. In this session we will look at private limited companies. Private limited companies are types of business where shares are only traded privately to family and friends. A shareholder is a part owner of a limited company. That's true of private limited companies and public limited companies. Shareholders buy a number of shares. The more shares that they own, the more control they have over the business. As a reward for investing in a limited company, shareholders receive a share of the profits, otherwise known as a dividend, if and when the business performs well. Private limited companies are formed when the business is incorporated. The incorporation process gives the business a separate legal identity from its owners. This means that the owners or shareholders are protected by limited liability. They can only lose what they have already invested in the business. Their personal finances are separate. Limited and unlimited liability are covered in a separate video. Private limited companies have LTD written after their name, and they are run on a day-to-day basis by a board of directors appointed by the shareholders. Most private limited companies are small. As a result, shareholders usually manage the business, more so than with public limited companies. Private limited companies tend to be smaller. The minimum number of shareholders is just one, so in theory, one individual shareholder could own 100% of the private limited company. But private limited companies can raise additional finance or capital by selling shares to invited shareholders. And the word invited is key there because shares are not for sale to the general public. One major difference between private limited companies and public limited companies is that with a private limited company, shares are not for sale to the general public. Two well-known examples of private limited companies: C&J Clark International Limited, note the LTD abbreviation. Clark's known primarily for manufacturing shoes, and Iceland Foods Limited, who sell frozen foods. Private limited companies give the owners, the shareholders, limited liability. As previously stated, this means the shareholders can only lose what they've already invested in the business. But private limited companies also allow more control to be maintained than perhaps public limited companies do. Because of the restrictions over the sale of shares, more control can be maintained, whereas in public limited companies, they can be sold openly and ownership can be more diluted. Finally, private limited companies can continue to trade if a shareholder dies. So unlike sole traders and partnerships, unincorporated businesses, private limited companies can continue to trade if a shareholder dies. However, the business accounts are not kept 100% private. Private limited companies do need to produce and submit accounts to Companies House, and there is greater paperwork and cost in setting up as a private limited company than there is with unincorporated businesses like sole traders and partnerships. The incorporation process means more paperwork and more cost. And although private limited companies can raise additional finance by selling shares, the restrictions on the sale of shares will limit the amount that can be raised. A business can only become a company after it has become incorporated. The incorporation process, remember, results in the business having limited liability and a separate legal identity to the owners. But students often use the terms company and business interchangeably. Sole traders or partnerships are unincorporated and therefore should not be referred to as a company, but as a business, a firm, or an enterprise. That concludes the session on private limited companies. Thank you for watching.